Chapter. We're talking real money.
Well, sometimes things seem to be too good to be true. I know, like this show. You're thinking, oh, man, this show must be too good to be true. There are a lot of things out there that seem too good to be true, and we, for some reason, end up talking about a lot of the financial things on this program, and that's what we're going to do today. I'm Don McDonald, Tom Cox over there. You are now listening to Talking Real Money, the radio show, or the podcast, and we are so glad you're doing it. And we ask, if you want to talk to us on Saturdays, you call us at 855-935-TALK between the hours of noon and 2 Pacific or 3 to 5 Eastern, no matter when you hear us. 855-935-TALK is the phone number, 855-935-8255. Now, the investment industry is rife with people promising you things you can't have because they desperately want to make a sale. Why do they desperately want to make a sale? You know why. They want your money. Sometimes they just want a chunk of your money. Sometimes they want it all. And it's hard to know which is which in this industry. But if someone was quoting you a guaranteed return of 17%.
10-year return.
10-year return.
Yeah.
17% per year.
That's
annual
right.
Yield of 17. Yep. Would you think that sounded, well, too good to be true?
You should, but many people apparently don't. The company is Yield Wealth. They were offering a 10-year term deposit, 17.1%, guaranteed by Lloyd's of London, and of course the FDIC for deposits up to $2 million. I don't even know where they came up with that number because the FDIC only insures deposits up to $250.
Yeah.
But the thing is here that's interesting is if, as expected, the Federal Reserve were to lower rates in September, which we suspect they will, that will probably lead to things like high yield savings rates going down, CDs going down. And there are going to be people like this that are going to pop up and say, that's okay, because we got you here with 17.1% yield. Now, it's a good thing. The industry does have people like Jason Zweig who looked at this and this must be,
although you'd think the government would have done it already.
Yeah, they will in 2 years. But Jason found this. Writes about, by the way, he called them. I mean, this must be like when 60 Minutes used to show up at your doorstep. He called them. And amazingly enough, when he called and started asking questions, the website came down, the offer went away, and the finger pointing began. It turns out that Yield Wealth is not the people actually making the offer. It's another company operated by a guy who was using a wrong name as the CEO because the real name he has, he's not allowed to be in the industry because he got booted out like 10 years ago for doing other bad things. But so it always, okay, so 17.1%. No, you can't get that guarantee. Never
okay,
could.
how about
that
15?
I know of.
Can I have 15?
Yeah, I never knew that one either.
Can I have 9?
Maybe if you go back to about 1980.
No, today. Can't I have 9?
No.
No, because guess what? Junk bonds. How much do junk bonds pay right now?
About 7.
Yeah, and they're junky. They have junk in their name.
Yeah, they may go up, they may go down. There's no guarantee aspect of that, of course. No guarantee of the yield and no guarantee of your principal for that matter. So I was like, okay, so what are things paying today? And this is prior to whatever the Federal Reserve is going to do. 10-year Treasury, which has always paid you back with the interest, 3.9%. Okay.
Wait, oh, you mean 3.9? You meant 13.9, didn't you?
No, I meant 3.9. You're working me here. I'm telling you. I'll talk to you off the air. I got a super secret deal.
Almost 15, 14%, 13% less?
And then there's the Vanguard.
I'm going with the 17.1.
Total bond, BND, paying 4.1. Still pretty good rate.
That is good.
DFIGX, which is dimensionals. I use this as a proxy for government bonds because it owns intermediate term government bonds. It's paying 2.5. But if you want to be even a little more liquid, high yield savings, you can still get 5.3. I suspect that will change very quickly if the Federal Reserve were to lower rates. A 1-year CD you can still get at 5.5, and these are from Bank Rate. And a 3-year, however, quite a bit less because people have already figured out that rates are likely to fall. The 3 years, only 4.6%, the best that I could find. So you can see that a 17.1 offering, while might make you feel good for a while, is completely outrageous. And please do not take them up on their not so kind offer.
They claimed that it was a test website and that no one should have paid attention to it. 17.1 is not an accident. It sounds like there's somebody looking to rip you off. 855-935-TALK. Give us a call.
Tom and Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Before we go to your phone calls, I just have to share a little more information on this yield thing because I just did a little research during the break. Now, I hadn't done any before this, but I was rereading Jason Zweig's article, and he said that on his LinkedIn profile, he claimed to have worked for Goldman Sachs.
Yeah.
And
wrong.
They called Goldman Sachs, and then he said, sorry, I made a mistake. I made a mistake. Anyway, I'm reading his LinkedIn. This is fascinating. And this is
the guy with Yield Wealth or with the other firm?
Yield Wealth. Kenneth Boyle, the CEO of Yield Wealth.
Yep.
He calls himself a visionary, disruptive CEO and co-founder of Yield, a pioneering neobank. Neobank. It's not a bank. It's a neobank.
Yeah.
So it's not a bank. Trust me, it's not a bank. Anyway, I looked at his CV. He's worked in the clothing industry.
Well, you got to look good if you're a banker. It's important.
And in the security industry, I think, maybe.
Security or securities industry?
Security.
Like as in like guarding.
Security.
Something. Yeah.
And he claims to have a Bachelor of Science in Business Administration and Project Management from a school called Colorado Technical University.
Which probably doesn't even exist.
Well, it does.
Oh.
Colorado Technical University has, quote, purposely evaded strict federal requirements and failed to provide students with the required number of learning hours needed to receive financial aid, defrauding the government out of hundreds of millions of dollars.
This just keeps getting better. Lawsuit. I mean, you need to call Jason and say, you look into this more.
Okay, wow. Here's what you have to, and by the way, in their offering statement that they filed with the SEC, which you have to file, they claimed in there, even though they said it was totally safe and backed by all this stuff in their advertising, in their filings with the SEC, they honestly state that investors must be prepared to lose all of their investment.
Where's the guarantee in that?
There is no guarantee. Wow. The legal guarantee is you can lose everything. That's what they filed with the SEC. That doesn't
sound like
anything
a guaranteed 10 years, 17.1. Doesn't make sense. Yeah.
It makes no sense. Anyway, 855-935-TALK is our phone number. Join us to talk about your money concerns, issues, thoughts, ideas, suggestions, whatever. If it's money, we're going to talk about it. And Dave in Tacoma, you're up. Welcome to the show.
Hey, guys. Well, like the engineer you had on just before the top of the hour who works for a company with a B at the beginning of their name, we're a federal agency that is involved with those guys with a big B. And we've got some of their employees that came and joined us recently. And they were looking at a little more work-life balance and job security. But they're looking at the TSP and asking me, well, what is that? And I kind of broke it down for them and shared some PDFs with them. And they said, but what is that similar to? And I said, I know some really smart guys on Saturday on the radio. And so I was wondering if you would take give a cursory description and your thoughts on the C, the S, the I, and then, of course, the horrible F bond and the G money market fund. And maybe take a look at that from not a life cycle stance, but how to balance that to meet where you hit on the risk quiz for those funds that you're
Well, let me start with just a quick answer. The TSP, for those who have been in the private sector, is very similar to their 401k. It's a very similar type of program. Now, the investments are specific to the TSP across the federal system. And that's what you were talking about, the various funds.
Yeah, and they are good in many ways because they're very low cost. They have decent diversity. The C fund is a common stock fund. The S fund is smaller stocks. The I is international stocks. I like the G fund. I think you called it a money market fund, but I think it's a bond fund.
Yeah, it's a bond
that owns bonds that Don and I cannot own. It's they issue bonds specifically for that. So between those four funds, you could build a pretty doggone good portfolio, very low cost, decent diversification. I am not as familiar, Dave, right now with what is offered at Boeing in terms of their retirement plan, because I haven't looked at it, I think, in a year. And every once in a while they change. I think there for a while was State Street, somebody else. So I'm not sure I know all the offerings. But in a general sense, Boeing's plan has been pretty good, too, because it is also low cost due to the fact that it has so many employees. It's always had decent diversification. So I don't see a huge difference between those two, frankly. But I'm happy to hear your opinion.
Well, no, and the thing is that the TSP has still I've never seen a private plan that has rates as low across
No, the costs
board.
are exceedingly low.
The G fund for your bond fund is really nice. The current yield on that right now is 4.125.
Not bad.
Which is right in line with Vanguard's bond fund, and it's all government, so it's safer. So the only way an employee is going to know where they should invest and how they should invest is, as you said, for them to examine their risk tolerance, not just their risk tolerance, but their risk need too. Because you may have some people coming over from Boeing who have substantial 401ks and they don't need to take a lot of risk. They're getting close to retirement. It really is a matter of risk tolerance and then risk need. And those two things go hand in hand, and then you build a portfolio that fits those. And one of the nice things about the risk quiz is it does give you a rudimentary, and I mean very rudimentary, stock bond ratio based, a suggested stock bond ratio based merely on your risk tolerance score. And
so, Dave, does that help? Is that what you're looking for?
That does. There's one other thing. They've got their Boeing 401s, and they would like to roll those out. And I was trying to think of what is the correct report process for them to roll that into something else. And they all seem to have those at Boeing's custodian, I guess, is Fidelity. And I said,
think you're right.
Fidelity should know.
Yep.
But, you need to make sure, because Fidelity, like Vanguard, is doing a few different things these days.
Yeah, I mean, and again, if it was me, I probably would just take it with me from the Boeing plan right over to the TSP rather than rolling it out into an IRA. But it depends on the individual circumstance, et cetera.
And here's what I would suggest every employee do. There's a great resource online at tsp.gov. It's tsp.gov/TSP Basics. It tells you how to move the money. There's a phone number you can actually call, and it just prompts you to do that has a rollover concierge. There's actually a person who will help you make it happen.
That's really cool.
So you can also do it online, self-serve, under My Account when they're registered.
Once they get it open,
once they get the account registered. So Dave, it's really, really easy. And do a direct rollover.
Yeah, you don't want to mess around.
A direct rollover versus an indirect. If you do an indirect rollover, then the 401k sends money to the recipient. Then the recipient has 60 days to move it. If you mess that up, taxable. Direct, just the money is moved right over and then very quickly reinvested in the stated, in the suggested or the requested assets.
Dave, it's a great question. We got to ask, how are things in the city of Destiny today? Because Don and I are both headed there in just a couple of hours.
We're going to the country club.
Oh, It's a beautiful day in the Tacoma area. It's 77, and come on down.
We have a spectacular wedding that we're attending this afternoon. We don't get to do this often, but this is a big wedding at the country club. So I'm getting dressed up and ready to go, man.
I'm not. At 855-935-TALK is our phone number. I'll put a jacket on. 855-935-8255.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
I'm Cox there. We're talking real money, and you are invited to talk real money with us at 855-935-TALK, 855-935-8255. And now from the City of Destiny, is that what it's called?
Yes, Tacoma,
no
sure.
idea.
Railroad went there first, dude.
Didn't know I didn't know it was Manifest Destiny. Anyway, from the City of Destiny to the City of Wind, which is...
That would be Ellensburg?
Chicago.
Oh, that's the Windy City. That's different.
What's the City of Wind?
Okay, all right.
Mark, welcome to Talking Real Money.
Hi, Mark.
Hey, man, thank you so much for taking my call. I got two layups for you here, but I want to remind you guys, I was John Elway at the Madison, Wisconsin Cookout there.
Yeah, we love you.
Yeah,
thank you. What a great time we had. Wow.
Good taste in jerseys.
Even you, Tom? You sure?
I had a great time. I loved the place.
Like
I loved
jersey,
the people.
but
that's a small thing. Yeah, but no, really, honestly, the welcome was phenomenal, and I can't say enough good things about Wisconsin. So really,
it was great. So you guys talk a lot of times, and you'll react, oh, it's Admiral shares. Oh, but it's institutional shares. And what I can never tell, is that positive or negative? Could you tell me the difference?
That's a great question, because this has all changed so much in the last 15 years. Yeah. Back in the day, go through so Admiral, what you have to have, I forget how much you had to have.
By the way, this is for mutual fund classes only.
Correct.
This does not apply to ETFs.
None of this does.
It used a little history lesson for you. Back in the day, way back in the day. Now, mutual funds are 100 years old now.
Yeah.
Originally, mutual funds had one share class. It didn't have a name or a number or a letter or anything. It was just mutual funds. And those mutual funds all came with a front-end commission and some sort of an expense ratio. Then the SEC allowed mutual fund companies to create some new share classes, B and C shares.
Similar type of ownership of stocks or bonds, but a different cost structure depending on how much money you gave them.
Right. Well, and how you got the fund. For example,
good point.
An A share would have had a front-loaded commission, but a B share wouldn't have a front load, but it would have an ongoing load, and then a surrender charge at the end. And a C share would have no front load and an ongoing fee forever. Then the mutual fund industry said, well, wait, it's not really fair if somebody's putting $20 million into these funds, or, $500,000 or whatever it is, to charge them the same. And that was mainly some of the no-load companies that started with that, like Vanguard. Yeah. They came up with the Admiral shares. What was it, $250,000 for Admiral?
I want to say 100,000, but I could be wrong. I
Maybe
can't remember. It's been a while. Yeah.
What Vanguard did eventually was just merged investment class and Admiral class, and everything's a $3,000 minimum. They're all the same cost. Institutional classes exist to allow 401ks, 403bs, big advisory operations, hedge funds to buy the fund and to pay no commissions and no 12B1 fees and a lower fee.
Yeah. And generally, by the way, when we refer to institutional shares, generally, we're talking about companies like not that long ago, like Dimensional, that didn't even make the shares available to the public. Now you can buy them. Yeah, you could buy them through exchange traded funds. Most of the mutual funds that they offer. So those were ones that were really truly only for institutions. So what are we saying when we say Admiral? And all that is jargon that's going to go away, because it really doesn't in today's world of exchange traded funds. It really does not matter, Mark. It truly does not.
Good. Because I'm a beginning investor. I want it to go away. I just need it simpler.
Yeah, and we want it simpler. We agree, and we think that ETFs are the solution to that simplicity. And we've seen it in the lower fee structures, and it's really hurting those who made money off of high-load mutual funds. It's hurting their business a lot.
Yeah, and I got to say, Mark, I feel bad for your Broncos coming to town already being a 5.5-point underdog to the Seahawks. So sorry about that to open the season. Sorry.
We love being an underdog.
Good, then you'll be a happy camper this year.
Question, yeah, that's right. My last easy question, I don't understand when I would use one over the other. Can you please help me understand the difference between qualified charitable distributions versus donor-advised funds?
Quick.
No, we'll take that up. There's more to it than that, but
you can't do it that fast. Okay. Charitable contributions, donor-advised funds. There is a difference. There's some complexity in one versus the other. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
All right, welcome back to the show. I'm Don McDonald with Tom Cock, and you are invited to be here with us by calling us at 855-935-8255. It's so easy. Come on, just call. We'd love to talk with you. And we'd love to answer your questions, like the question that Mark had before the break about the difference between various ways of giving money to charity from your estate or from your RMDs.
Yeah, that's
what are the options?
That's exactly the separation, because a donor-advised fund generally is where you take money from a brokerage account, savings like that, put it in the donor-advised fund. These are operated by people like Schwab and Vanguard and others. You put it in there, you get the tax deduction for that. And oftentimes it's like a stock that's gone up a lot, right? You bought it at 3 and now it's trading at 300 and I don't want to trade they set it in there. They manage that for you and you can give it away to the charities you like, but you take the tax deduction right then. The money goes in, it's managed. You can give it away to the charities you want, whatever way you want to do it. That's completely different than a QCD or qualified charitable distribution, because that comes from a qualified account, individual retirement account. Correct. Because remember, at age, for us old people now, when we hit 73, we have to start taking money out of those IRAs, pay the tax on it. Once you reach 70 and a half, you can do the qualified charitable distribution, where instead of paying the tax on it, you don't get a tax deduction, but you don't take it as income either. So it just goes right from your account to the charity that you like. So in a way, it reduces your taxable income, right? Because you're not paying tax on something you would have to have paid tax on it, and you're charitable at the same time. So they're very different things, but I love them both as ways to give to charity. They're wonderful.
And I hate to throw this in to confuse the situation, but then there are also charitable remainder trusts.
Oh, that's a whole different worms there.
That's a way of giving your money away,
correct,
but still being able to use some of your money along the way.
And we have people that do all of them, by the way. I love QCD. If you were have been a great saver in 401ks, IRAs, that kind of thing, and you really don't need a lot of the income from them, and you want to be charitable, QCD is a wonderful option, because as I said, you're reducing your taxable income and you're helping the charities you'd like to help. So I think they're fantastic.
Our phone number, again, 855-935-8255. You can call every Saturday between noon and 2 Pacific time, which is the time zone where the show airs, or 3 and 5 Eastern. Or you can send your questions in at talkingrealmoney.com too. But let's go back to the phones. And Dave in Seattle, welcome to Talking Real Money.
Hi, Dave.
Thank you for taking my call. So my question is, I've been buying investment real estate for over 50 years, and it's not so fun anymore. And is there a way to, I would do a 1031 to buy something else, but I mean, can you get out of real estate or partially out of real estate and into what you guys are talking about?
Without paying taxes? No.
Is that what you're asking? How do I sell this and get out of it?
Yeah.
You can't do the
No.
Like the 1031s.
No, a 1031,
That's just kicking it
for those
down
who don't know, is basically kicking the can down the road. It is a like-kind exchange. You can sell a piece of real estate, and within a certain period, based on certain rules, buy another similar piece of real estate, and continue the capital gains, Deferment, yeah. That's the word I was trying to come up with.
But we don't have any trick to selling something and not paying tax. Well, there are people probably would tell you they did.
Yeah, but it's the trick is probably not legal or on the ragged edge of legal.
Delaware statutory trust.
Well, the DST is still a 1031, basically.
It is. Yeah. So you're not really getting out of
1031. Yeah. No. But here's
I have an idea. Go ahead.
Go ahead, Tom. No.
Well, I was going to say, here's another idea, Dave. You could diversify your holdings. I know of a home, for example, you could buy in
stop.
Woodinville.
All right, never mind. Stop. Okay. I'm just, he's so bad. But what I would do is if you own multiple properties, I would begin a tax planning strategy.
Exactly.
To start unloading those in the most tax advantageous way. And that would require, like most people need at some point in their life, a good fee-only financial advisor, CPA, somebody who's really gonna sit down and do the calculations and then determine the best places to put it after you liquidate.
Sell it out over time, for example.
Sell it out slowly.
Yeah.
Sell slow.
Yeah, but there's no magic bullet here that will alleviate the tax situation while allowing you to collect the money.
Wait a minute. Offshore account? We could go to the Isle of Man, maybe.
That's on our Sunday program, so tune in for that. Late night.
Late night and different names. 855-935-TALK is our phone number. Call us because we still have a whole lot of time to spend helping you.
Tom and Don are talking real money.
Do you suffer from Hodgepodge-itis? I'm Don McDonald, and Hodgepodge-itis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from Hodgepodge-itis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from Hodgepodge-itis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodge-itis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
You know, this will only relate to those listening to the live show. I was just listening to the traffic. Sounds like traffic's terrible down around Tacoma.
Yeah, I'm heading in the exact wrong direction today, so that's okay. Well, it's a wedding that happens, and we want to say best wishes to Ricky and congratulations to Sean, two of our folks we work with every day who are getting married this afternoon. Lovely people, very happy, both really great people and tremendously successful professionally for their young ages. It's remarkable. So hope it's a great afternoon for you too.
You are so Emily Post.
I'll take that as a compliment. I'll take that. Your wife's the same way, by the way.
I know she is.
She would do the same thing. She would be right there with you.
Same thing, and I wouldn't. I would just go, yeah, nice guys.
I want to finish on the tax thing because this is you and I have the same thing coming up, right? We haven't talked much about this, but at some point we're going to want our money back from the stock that we own in our little firm.
Yeah, that. Yeah. Oh, that one. Yeah.
And we've been kicking that around.
Well, we ran into that when we
did.
Our other firm. The capital gains hit is painful, folks, but it's the cost of admission.
Doing business. Yeah. I mean, it's the cost of living here.
States.
Right. Yeah. Yeah. And actually, technically right now, with the long-term cap gains rate at 15%, which may end at the end of 2025, rates are pretty low. So, I mean, if you look at historically, that doesn't make it feel better when you write the big check for that. But, and then here in the state of Washington, I think it's over 250,000 in gains, you're going to have to pay the 7% state capital gains tax as well. So yeah, it adds up. But what we're kicking around, and if you're listening at headquarters, this is not imminent, but maybe taking it over time, right? So the bill doesn't go way up.
That's the same kind of strategy that I would, that we were talking about with the real estate.
Correct.
Is you need to do some tax planning, and it's part of the whole financial planning process.
Yep.
You have to, while investing and the whole concept is relatively simple, there are a lot of things that can trip you up along the way. Tax planning is one of them. Mm-hmm. Another one is first you got to figure out which assets to own, and then you have to figure out where to put them, particularly as you're getting closer to retirement. What kinds of accounts those assets should be held in.
Yeah, and people have a tendency to forget that. They think, oh, it's something the rich people do, and I don't have to worry about it. And that's really not true. I'll give you an example. So if you own anything in a Roth IRA, which gets this unbelievable favorable treatment of no tax on it after it's grown from X to do. So that's where the, things that you would expect to grow the fastest should go, right? Because I'll give you an example. If you own U.S. small cap value stocks for almost 100 years, those have made about 4% more per year than the Standard & Poor's 500. So those should be piled into your Roth, right? Because there again, if you expect the future to look like the past, they grow fast, tax-free, it's awesome. Conversely, and this is a big mistake I see people make, especially people with money. They own regular taxable type of bonds in their brokerage type accounts, which are paying interest, and you have to pay the tax on that. And there's no reason if you want to hold bonds, those should be in your qualified type accounts like IRAs and 401ks, because there doesn't matter what happens inside those accounts. That just continues to grow, paying it out, but it's not creating any tax hit for you on a regular basis. The only time you're going to pay tax there is when you start taking it out. This all needs a lot of consideration, I'd say, for almost anybody who's an investor. Now, in the article, they mentioned you really got to be at the 24% bracket before you're really getting serious about this. I would argue no. You should be paying attention to it all the time. Maybe not making huge adjustments today, but knowing these things from whenever you start investing and building the appropriate portfolio, Don. Most people do not. Most people we look at, they have bonds in the wrong place, wrong type of stocks in wrong accounts, and they just don't care. This is the way I've done it. It works. I've made money. You've made money, but you've also acquired a partner you may not want to have called the government.
It's easier too, and we do try to take the path of least resistance. But to your point about the Roth IRA, because a lot of people are going to be saying, well, wait a minute, shouldn't I put my immediately taxable bonds and things in there? Not really. Here's why. If you put let's say you got $100,000 and bonds earn on average 4% per year. We're just going to, for argument's sake, say 4%. And you keep that $100,000 in your Roth IRA, protected from those income payments.
Yep.
For the whole time and protected from capital gains. At the end of 20 years, you will have made about $122,000 on your money. Okay? So you don't have to pay taxes on that whole $122,000. But what if, and this is not an unreasonable number, let's say you would have gotten 8% per year on a 100% stock portfolio in your Roth. Now you have other things, other places. You just got 8% per year over that same 20 years. Instead of having a $122,000 tax-free profit, you would have an almost $400,000.
So almost 4 times as much. Profit. Yeah. I mean, it's a big deal.
Over 3 times. Way over 3 times.
Big difference. Yep.
That's a lot of, in fact, at current tax rates, you're going to have almost $122,000 more money.
The difference.
Just by way that just the difference in not paying taxes. So having the right plan is a crucial part of this whole investing process.
I don't think it gets the credit it deserves. Generally,
I don't either.
People just don't pay attention to it. They think, well, but I'm diversified. Yeah. And I've got some stocks and some bonds. Okay. And I'm using low cost index or exchange traded funds. Yeah, that's good. But this tax part should be tackled on a regular basis. It should be considered. It should be looked at. I mean, even if you have things like Dave asked about selling something, even if you don't, building the right portfolio with the right places that's a huge difference there. Wow. After tax.
It's huge. And the other thing is, this is just a one item in a plan. This is just one little item that can make a huge difference. The reason Vanguard has this very famous report called the impact of Advisor Alpha.
Advisor
to that effect.
Alpha, correct?
Alpha,
yeah.
And in there they say that if you have good advice, you can make 3% per year more. And one of the reasons is because of picking up all these little tiny extra things along the way that help boost returns that you get from a fee-only advisor. Most of the folks in this industry poo-poo planning because they're transactional.
Yep.
They are trying to sell a product, move on to the next person, sell a product, move on to the next person, sell a product, move on to the next person. Planning is rare. It is incredibly rare in the financial services industry. So you must work with someone who is adept at planning. It is so crucial. And of course, you don't want someone transactional. You want someone who doesn't get commissions. But I can't overstate the particularly when you get to our point in life. When you've got money, you don't want to lose it. You want to use it properly. This is the time.
And I'll add something to that. In today's world, even up to 10 years ago, financial planning software didn't spend much time on things like this. Now, we've got tax planning software where we can put all this in for the future and say, here's what I'm thinking of doing. Does this make sense? Am I staying in the same bracket?
Don't tell people your secrets.
Oh, I'm sorry.
I thought you guys slaved at night over an abacus.
Punching it into the abacus there where we, sorry. So, I mean, and it's so sophisticated that you can look at things like Roth conversion. Seems like everybody always asks me, I'm going to convert my Roth. I'm like, why? Oh, maybe so I pay less in taxes. Maybe, maybe not. So all those things should be considered, and the help is there. That's the part that I was going to say.
Want to take advantage of our last moment of potential conversation? This is it. Call now, 855-935-8255.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
You know, looking at my route to the wedding, and I've got clear sailing.
Yeah, you're right up there. Boom.
Going north on I-5. I'm good.
South. Whole other story. Yeah. I'm heading south.
I'm sorry. I know you guys on the podcast have no idea what we're talking about, but just to let you know, we do a show in the Puget Sound area on Northwest News Radio, and that's what becomes typically our Tuesday and Wednesday podcast, because I have to have a day to get it edited and approved by compliance. And then this week, though, it's going to be a little different. So the radio show will be Wednesday and Thursday.
Because people won't be working on Monday.
Because people don't work on holidays for some reason.
Yeah.
I don't know what's wrong with us. We're a bunch of lazy so-and-so. I sent a note to my HOA board's attorney on Friday early.
Never heard back.
Saying, no, I got a response message saying we're closed for the holiday. We'll be back Tuesday. I'm going, it's Friday.
It's not Monday yet.
The holiday hasn't started yet. Get back to work.
I got to say, I got a nice note from one of our advisors today when I asked a question this morning. I was like, wow, that's great. There's only a few of them I know that work regularly on Saturdays. So
they know you're the boss. You're going to respond.
I see. So it's, they don't do that with everybody. Okay.
You think? You're at the office.
Some do and some don't. I know the ones that do.
You're at the office where very few people show up.
There's not a lot of people here right now. The only thing that's here is the high heat of about 87 degrees inside.
Is it hot in there again?
Ooh, smoking. Yeah.
Same in the trailer. Mm-hmm. Same in the Airstream.
One hot mic.
One hot mic. And as a matter of fact, I'm just counting the minutes, 2 minutes, until I can turn the air conditioning back on. And we want to share a couple of things with you. One, if you live on the East Coast and you want to come to our retirement meet, we got one coming up on the East Coast in Hartford.
October 19th.
Glastonbury.
Yep.
October 19th.
Retiremeet.com.
Would you like to share something else?
No, nothing else. Both of us will be there speaking, so join us. Among others. Yeah. Among others. Yes, we will be.
We will be. And then the other thing is, we have this really cool website. It's called talkingrealmoney.com. coincidentally. And there you can find our podcast. You can find some really, really, now they're not new, they're old, but they're older articles about the science of investing. There is some really powerful stuff there from us and from Dimensional Funds and others. Really, really great written information, along with the spoken, the podcasts, and you can also communicate with us there. You can ask questions that get answered on the Friday podcast or on other podcasts. If you go to talkingrealmoney.com and click the contact form, contact us, there are two options to ask questions. One, you can type them. If you're a good typist, I'm not, so I prefer speaking them. You can speak them. The spoken questions will be answered on Friday podcasts, the Q&A podcasts on Friday. The typed ones will either be answered on the Saturday show that becomes a podcast or on the other podcast.
This is so confusing. I don't know.
Ask your questions.
Okay, in whatever form you wish.
And the answer, but the thing is, I want people to know when they can hear the answer. That's the thing.
I see. When to tune in. I wouldn't tell them that. Just we'll answer it when we get to it. Listen.
Oh, so basically Tom's advice is you better listen to all the shows.
That's right. I have a guy I just talked to last week who only started listening to the podcast like a year ago. Now he's going back and listening to all the previous 1,600 podcasts or something. Thank you for that.
And finally, you can meet with one of our advisors just by going to talkingrealmoney.com and clicking on the Meet an Advisor button.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.